So where does a company get its money? Gabe.
They can get it from their customers, but they can get it through loans or investments as well.
So say more about what do you mean by their investments?
Or I guess people investing in the company.
Well, both your answers are right, actually.
Right, sure.
But the first one, from their investments. I'm surprised at that one. Say more about what you mean. It's true.
I guess I meant people investing in them, but we'd also talked about last class how companies have extra cash sometimes and make investments to use that money.
Yeah, they can actually make investments in another company, and I think we may have mentioned that Microsoft actually earns about half of its earnings from its investments in other companies. So it's not true of very many companies, but there are companies where, in fact, that's part of where they're cash from. Where else do they get cash from?
Sales, whatever product or service.
Yeah, we talked about customers, yeah. Where else? That isn't one. Carla.
Did you already say banks, loans?
No, they didn't say banks, so that's another one, right? They could borrow money. Right? And then we mentioned one other more obscure one, I think, last time. They can sell stuff, not their products or services, but they could do what?
Ownership.
Ownership would be selling stocks.
Stocks, yeah. Selling assets.
Selling assets, exactly right. If they've got equipment or buildings that they don't need anymore, so they can sell that and raise cash. So very good, okay. What does money mean? What about sales? May or may not be, depending upon what?
They require them to pay immediately?
Yeah, if they paid with cash immediately, then in fact sales translate to money or to cash. But in fact, if they bought it on time, or they've got 30 days to pay for it, then in fact the sale is not the same thing as money or cash, right? What about profits? Is that money? Thomas?
Doesn't have to be.
Why not?
Well, I think in the definition of profits, it's pretty much just how you balance your, or how you do your accounting, and you don't need to actually have cash to have profit.
Yeah, because we talked about sales at the top of that statement, right? But that may or may not be for cash. Hopefully you collect cash at some point. And then we've got expenses, and some of those expenses are cash expenses, but some of those are not currently cash expenses. Can somebody give me an example of that?
I just don't know the word, but when you write stuff off, I mean...
Okay, so you depreciate, you buy a piece of equipment and you say, how long is it going to last? And I say, I think it'll last about 6 years. So you depreciate it over, excuse me, a 6-year period. You take each year's depreciation, count that as an expense, even though the cash expense would have been when you bought the piece of equipment or when you're paying for the piece of equipment, but it's not likely to be the same as depreciation. So profit is a constructed number, can be very, very different than cash. All right? And then cash. So where do we actually find a corporation's cash? How much cash they've got?
Show up on the balance sheet.
Shows up on the balance sheet, exactly right. Underneath the asset side, there is an item that's called cash. Sometimes it's referred to as cash or near cash. So if you've got money in a savings account or something that you could immediately retrieve, we'd call it cash or near cash. So we can't find cash on the income statement. Only place we can find cash is on the balance sheet, and we can see the history of cash where?
Cash flow statement?
The cash flow statement. And remember, I've sort of suggested to you that for a lot of companies, including mine, first place I looked was not the income statement, not the balance sheet, but I looked to the cash flow statement. So sales for cash, collect accounts receivable, sell equity, borrow, sell assets. We've talked about all of those, okay? So how does a company keep financial score? How does it know if it's a... Good morning, Coulter. He's joining us on video. He said he wasn't feeling well today, so rather than infect every one of us, he made the wise choice and said he'd join us remotely. So,
Thank you, Coulter.
So how do companies keep score? What kind of numbers do you think they look at?
Do they use like profit and loss statements? I mean,
What if you ran a company? What's the first number you'd want to know about it?
Probably care about your stock price.
Stock price?
First one, but one of them.
That certainly would be of interest to anybody who owns shares, right? To know what the value of their asset is, right? But if you're the manager of a company, stock price you can maybe influence, but do you determine stock price? No, who does that? The market, or even more precisely, the last person who bought and the last person who sold. In other words, they agreed to have an exchange of a share of stock. They determine the price of what a share is worth. Right? So one transaction, the most recent one, determines the value of a share of stock. Coulter, do you have your mic on? Would you
Maybe.
Would you mute it? Thank you. Thomas over here was... Thank you. So what are the number? Obviously, stock price is going to be of an interest to manager because they're going to be partly evaluated by what's happening to share price. They may own some shares of stock, so they're interested in that. But on a more regular basis, what do you think they're held accountable for? What do they look at?
CFO I work with, they are dealing with an FCI, which is like a financial condition index, which I was curious about because it's not really the private sector.
Yeah.
But it relates to like how much debt the institution has compared to how much bonding or.
But a pretty sophisticated number. I'm thinking of things that are more straightforward. How about sales? Do you think management watches sales? Yeah, I mean, that's their first indicator of how things are going to turn out, right? If your sales are dropping, you're probably going to have some challenges. If your sales are growing, there's at least hope that things are going to do well. So after sales, what do you think would be the second number they'd look at?
Operating profit?
Yeah, they'd look at some sort of profit number, right? They may look at, that's a great answer, operating profit. They may look actually at the net income or the bottom line profit because that's the one that most outside people are going to look to, right? But if you're an operating manager, the best number to look at is the operating profit, right? What other numbers could they look at? What about the cash on hand? Think that might be important? If they've got a lot of cash or near cash, they have what? They have hope. Said another way, they have opportunities. Right? If you got cash, there's hope, there's opportunities. But if you're low on cash, your field of choices is pretty limited. Right? Because you've got cash, you can do stuff. If you don't have cash, you're pretty limited. So, income statement. The one that most people would jump to and sort of say the first thing I want to see is an income statement. Second item, a balance sheet. And the third one, cash flow statement. So those are the three primary statements maintained by basically all significant companies. And they have an influence upon stock price and dividend. These we would call internal documents. In other words, inside the company, how are we doing? For external consumption, these are the things that pop up in the outside world. Are they paying a regular dividend? They're not paying a dividend. All right. And what's happening to stock price? But those internal documents influence but don't determine the external measures. So, we start today on a couple of sessions long thing on what is the core of the course, namely financial statements. Right? So, if we're interested in your own personal welfare, you're probably going to think about owning some stocks. And so it would be important for you to understand what the financial statements are telling you. Right? If you're moving up within a company, you'll want to know how the financial statements look, what are the trends in that. If you're thinking about hiring on to a new company, you'd probably want to look at this to maybe even historically to sort of say, what kind of pattern is this on? So these become sort of the foundation for a lot of our subsequent discussions will be these financial statements. All right. So, income statement, balance sheet, cash flow statement. Income statement, pretty simple. Revenues, we could call it sales, minus expenses equals income. Income is also known as what?
Profit.
Profit and loss kind of thing. Sometimes called net income. Balance sheet, assets, what else?
Liabilities.
Minus liabilities equals?
Stockholders' equity.
Stockholders' equity. Right. What do they own? What's the net of what they own? And then the cash flow statement, beginning cash, sources and uses of cash, and ending cash. So at their simplest level, these are the three financial statements. All right, so the income statement, balance sheet, cash flow. What are the three parts of the income statement? Noah?
Sales.
Right.
Your expenses. Taxes.
No, just three. What are the three basic parts of the income statement? You got two of them. What's the bottom line?
Oh, your net.
Your net, your profit, whatever, right? Okay, so I'm just looking for seeing if we can repeat back what was on the previous slide, okay? At the most basic level, what is an income statement? It's revenues minus expenses equals profit or net income. Right? What about the balance sheet? Gabe. Sorry, I got you in the middle of a potato chip there.
So the balance sheet will be assets minus liabilities.
Equity, okay. Anybody know what another term for equity is? Stockholder equity, another one? Net worth, okay, so it's another one of those words. All right, so assets, equity, cash flow statement. Dan.
Gosh, it's like the beginning.
Beginning cash.
And the outflow. In
sources and uses of cash, leaving you with ending cash. Exactly right. Okay. So income statement. Income, sometimes referred to as net income, sometimes referred to as profit and loss. There are these synonyms that are often employed. Earnings is another one. All those refer to the same thing. Okay? Not on the income statement, but the question then is what happens to income? How can income be used? It can be used to pay dividends, right? In other words, hey, we had this income this year, so are we going to declare a dividend? We're going to use some of that income for a dividend, which is what? Returning it to the shareholders immediately. Who owns that income? Who does it belong to?
Shareholders?
The shareholders, yeah. So we sort of say, hey, are we going to give them any of this income? So one choice is to take that income and to pay it out as a dividend. What's the other choice?
Retained earnings?
Retained earnings, exactly right. So there's two things that happen to income, not shown on the income statement, but the two things that can happen to income is it can be some of it can be paid out as a dividend, and the balance, maybe all of it, going to be retained for use within the company. So if a company is growing very, very quickly, what do you think they do with their income? What's the most often do? Do they pay it out as dividends or retain it? They retain it, right? Because, hey, it's not costing them any interest, right? It's in some sense free money. But furthermore, the company sort of says, on behalf of the shareholders, I think we can get a larger return for our investors by retaining the profit and investing it in the business, right? So for fast-growing companies, often it's not paid, income is not paid out as earnings, as dividends, it's retained. On the other hand, if you're a utility company, power and light, okay, very often they will pay a dividend. In fact, all of close to earnings may be paid out as a dividend. Why?
They don't really need to grow very much ever?
They don't get to grow very much, right? I mean, most of those are publicly controlled or public utility. So some governing body sort of says, here's how much profit you can make. And they don't have a lot of growth opportunities. So people buy utility stocks because they like the dividend. They don't expect that the stock value is going to go up, but they're going to get a nice dividend check each year. All right, so dividends, retained earnings. I put this below the line because it doesn't show up on the income statement, but I want you to understand what are the two. Now that you've got some income, what can you do with it? You can either pay a dividend or you can retain it for purposes within the company. Who decides that? Shannon? The Board of Directors, exactly right. So balance sheet. Net worth, book value, equity. Where does equity come from? Well, part of it is what? Common stock. You've sold stock in a company. People have given you money, right? So they bought some shares of stock. That's called common stock. And there's how much funds have you raised? How much equity have you raised by selling stock? Anybody want to take a stab at what's the other source of equity? Retained earnings. Exactly right. So it can either be from the sale of stock or by retaining earnings. Those two things add up and give you equity. That equity then is used, right, to pay for assets and to cover liabilities. Okay, getting sort of comfortable with the general flow of things now, what, at a sort of macro level, what these things are telling us. So, and note here an important reminder, this is cumulative retained earnings. Since the formation of the company, how much of its earnings has it retained? This is not its total earnings. Why is it not its total earnings?
Paid dividends.
They paid some dividends. So this is just the question of all of their earnings since the beginning of time, how much have they retained? So they've raised, equity comes from how much stock have we sold, and secondly, what is our cumulative retained earnings? Not current year retained earnings, but cumulative retained earnings. Yes?
So I'm a little confused about retained earnings. It's not cash only. Does it also include other kinds of assets like inventory?
Yeah, it does not have a clear distinction because some of those, remember, what do we have? We've got assets minus liabilities, so it's not the same thing as cash. We don't know what form it's retained in. It may be in equipment, it may be in accounts receivable, it could be anywhere in the balance sheet, okay? So don't think of it as cash, just think of it as these terms, what they stand for. Great question, by the way, great question. Then the cash flow statement, beginning cash, now we get into breaking that out. So beginning cash, we're going to add or subtract from that operating cash flow. Remember we talked about by operating the business, Are you generating cash or using cash? Right? When I had companies that were growing very, very rapidly, they were using cash in the business because we were buying lots of equipment, right? So we were using a lot of cash in the business for operating purposes. Secondly, then, investments. This, again, is equipment kind of stuff. And then financing. And so that's then going to give us ending cash. So we will then need to understand, how do we calculate operating cash flow? How do we calculate investment? How do we calculate financing? And of all of that, what's the most important from a business standpoint? Why are you in business? You're in the business for operating cash flow. Not for cash flow, because you can generate cash flow by borrowing money. Right? You can generate cash flow by selling assets. But you're in business for operating purposes to generate sales, cover expenses, and be left with a profit. But more precisely, you're in the business to generate an operating profit, right? To generate operating cash. So we can talk about three bottom lines. Income, that comes from what statement? The what?
P&L.
P&L, income statement. So income is one bottom line. Equity, that comes from where? The balance sheet, assets minus liability. So that's another bottom line. And then thirdly, cash. And where do we find cash? Cash flow statement at the very bottom. Starting cash, sources and uses of cash, ending cash. Right? So think about those as the three bottom lines. You'll often hear in the popular literature, hey, what's the bottom line? They're referring most often to the income statement, to the profit and loss number. But in fact, a company has three bottom lines, one for each of the statements. And then those three things affect stock price and dividends, so that would be what? Some sense, what? The fourth bottom line is what are you paying out in dividends and what's happening to your stock price. Okay. So what's the best measure of financial performance?
I'll be wrong.
You had lots of ways to be wrong, right? It's sort of an unfair question because there's only one right way, but a lot of wrong ways. What would you say?
Well, I was going to say that it's the EBIT or EBIT number, but I'm suddenly reminded of our first chapter axiom, which is that the best measure of financial object of running a business is to increase shareholder value. Mm-hmm. So I'm probably going to go with that, ultimately speaking.
All right.
It's a broader thing.
He used the term EBIT. What's another phrase for EBIT? What? Yeah, that's the definition of it. I'm saying, what's another term that means the same thing as EBIT?
One of the profit levels.
It's one of the profit levels, and
Gross
specifically
profit.
it's the what?
Gross profit?
Operating profit. Yeah, EBIT, operating profits, same thing. So we'll be going over these again. So we have lots of possibilities here, right, to think about. And it probably depends upon who's looking at the numbers, right? Right? Which one's most important? For example, if you're a banker, right, you may have a different focus than, say, a shareholder. If you're a manager whose bonus is being based upon some number, for example, if you're the head of sales, you're probably going to be most interested in what's the sales number, because that's how your bonus is calculated, right? If you're a senior level manager and your bonus is based upon profit, then that's the number you'll probably be most fascinated with. So I don't think there's a single answer to this question. It depends upon who's looking at it and what their incentive is for looking at it. So to wrap up this session, this part of the session, the blank gives you a snapshot of a company's financial situation at a particular point in time. Why do you say balance sheet?
Point in time.
Very good, because it's a point in time. That is the one statement that is for, I can't answer this without you telling me what's the date. End of the year, beginning of the year, beginning of the month, end of the month. In theory, you could sort of say, I want to know it for June 15th. Okay, that would still be an appropriate question. It's not calculated daily, but it's for a point in time. So that was the giveaway. Tells you the company's sources and uses of cash over a period of time. You can't blow this one, right? This is too easy. Cash flow statement. And then the what tells you the top and bottom line. There's only one left. Thomas? Income statement, right? The phrase there you often hear, what's the top line? How did we do on sales? What's the bottom line? How did we do on profit? So that's another sort of common terminology, top line, bottom line. We're referring to the income statement. So we begin with the fun. So we're going to be on this for a couple of weeks, this case study. Here's the setup. I'm going to be the president of this company, actually the founder of this company, and you're my board of directors. Right? So I'm reporting to you financial results to the board, and you're encouraged to ask me any question you want to ask me about the results. Offer any opinion, hopefully well thought out, about what we should do next. Right? But you're going to play the role of board members. As a board member, what's your involvement in this?
Represent all the shareholders.
Represent the shareholders, right? That's why you're part of this thing. But you may yourself be what?
Shareholder.
A shareholder. It's often a requirement. When I served on the board of outside companies, outside my own companies, it was often expected that I would buy a significant amount of stock in the company. Right? Sort of the price of serving on the board, for which I got some compensation, but that was far outweighed by the investment that I made in the company. Why do you think that's sort of a good practice?
Decisions affect you.
But to make sure you acted on behalf of what? The shareholders, including yourself as a shareholder. So it's something that I think is good practice. And of course, the larger their investment in the company, the more conscientious they're going to be about looking out for the good of the shareholders, because it has a meaning for their pocket. So you're shareholders. You're going to be asked some difficult decisions. As best you can, presume that you've got money tied up in this company. What would you do? Not sort of in an abstract sense about shareholders, but what would you personally do if you held stock and sat on the board for your own self-interest? What do you think is the right route to take here? So this is comes from the textbook. De Leon, we're in the nut business. We grow nuts, we process those nuts, we package those nuts, and we sell them primarily in the southeast part of the country. Right? There's a lot of agricultural products raised in the southeast because the climate is pretty friendly. Don't have frost, typically. There are rare kinds of things. But it's an agricultural enterprise dependent upon that. I, along with having discussed it with the board last year, we decided to undertake a major expansion and go national. We were very successful in the southeast region. We were competing in that region with all the national brands, and we sort of said a way to grow the company, we could add more products to our product line, or we could open up the entire national market, and I suppose someday we could even dream about going international, but we certainly could begin to think about opening up the entire national market as probably the fastest way to grow the company as compared to just expanding the product line within the southeast region. And we were comfortable thinking about that, you and I, because remember you were here last year as a member of the board. We were comfortable with that because we were competing with the national brands in our region already. So competing with them on a national level was not a new experience for us. And we believed that the results would be greatly increased sales, profit, and the all-important stock price. So that's what motivated us a year ago to step up to this. And by the way, as I recall, the vote was unanimous to proceed with this expansion plan. We had a lot of good discussion, but if my memory is faulty, anybody want to sort of say you disagreed, let me know. Right? But here we are a year later. We felt last year our products were higher quality than the competition, and that quality could demand a premium price, and we had evidence of that by our successful operation in the Southeast region. So we doubled our plant capacity this year. We opened new sales offices. Why do we need sales offices? Because we got to get people to carry our product. That typically would be convenience stores and gas stations and other kinds of things where you find these nut products. Probably also the major chains, Target and others, and they don't just add new products. You've got to go out and sell them, convince them that it's going to be a big seller and that they're going to get good returns by using some of their shelf space. What you really buy in these retail outlets is shelf space. So, and we also had to launch an expensive advertising program. Why?
Outside your home area didn't know who you were.
Yeah, so you got to get people who walk into the convenience store who said, hey, I remember this thing. I think I want to give. You see it, you give it a try. So you got to get the stores to carry it, and you got to get the people to ask for it, or at least pick it up when they see it. Yes.
So in this scenario, can we ask you questions about the backstory that you're just talking about?
Sure. I may not answer it, but you can certainly ask.
So as a board member, please refresh my memory. I don't recall, did we do any studies, like marketing-based studies, that would help us decide on this expansion, or did we just look at the fact that we were doing well in the Southeast region?
The latter, yeah. We were primarily motivated by, okay, now certainly we had, as members of the board, you're to bring a broader view of this, and you certainly had an opportunity last year if you had any reservations why nut products would be different in the Southeast versus in the Northeast or the West. But as I recall, there was not a lot of discussion about that. The sort of sense was this country is homogeneous enough that if a product sells well in the Southeast or any region, since it doesn't seem like a regional product, it's not like chitlins or pork rinds or something that might have a regional taste to it.
Finance our new fixed assets.
How do we finance the expansion?
Yes.
Yeah, well, what do you think would be a good way to do that? You don't recall the conversation, so what do you, if you were financing doubling plant capacity is going to be expensive. So how could you finance it?
Well,
let's start there.
If you have equity that you can pour into it, that'd be the good first place to start.
What does that mean, equity?
Well, I was thinking of the calcs for free cash flow, basically. Cash that's not tied up in your current operations.
Oh, you mean if you had cash on hand?
Yes.
So if you had a bunch of cash on hand, would that be the first thing you'd use?
To a certain point, yes.
What would the certain point be?
Well, I forget what the calc is. Something like it's your operations. It's your cash on hand minus what you need for continued operations. Minus your interest rate.
So let's just back up a little, make it a little bit simpler. So if we had a big pile of cash,
yes,
right, or it was invested in stocks that we could sell, it's liquid cash, right? Our investments were liquid. Would you suggest that the first place you'd look to finance this would be to use whatever cash you had that you didn't need on a day-to-day basis? In other words, this was excess cash. Is that the first thing you'd use?
Would be the first thing I'd use? Yes. Would it be the only thing I'd use? No.
Okay, so what would you use after that? Where would you get the remaining cash?
Other forms of equity, like
You'd sell some stock. Yeah,
perhaps
presumably you
sell
got some stock that you haven't sold yet. You'd sell stock.
And
So we could do that.
I assume you could also leverage your retained earnings.
What does that mean, leverage your retained earnings?
Oh, what that means to me is put up inventory or other forms of...
Put it up to be able to do what? I think
To be able to borrow against
to borrow
it.
money, exactly right. Yeah, so borrowing money would be another choice, right? So now we've got, trying to go back a year, and sort of said, well, if we had any, quote, available cash that wasn't going to need it for day-to-day operations, we could use our own cash, stock of cash. Secondly, we could sell some more stock, sell some more equity. Or thirdly, we could borrow.
Wouldn't selling more stock dilute our current
Absolutely.
shares?
Yeah, absolutely.
We wanted that? Guess so.
Why? No.
Why not?
Yeah. Why don't you want to, what we call, dilute the ownership? Why do you... As an owner, would you like to see your ownership diluted?
Probably not.
Probably not, right? You'd like to, if possible, right, have all this improvement in profit, right, accrue to you, to the current shareholders, right? That would sort of say, let's not sell shares, because for every share I sell, I'm diluting that income is going to be spread over more shareholders. So that might be an argument, let's not sell equity, right? Just like, hey, if I've got a stock of cash, do I really want to use it up because who knows what the future is going to bring? So maybe I'd want to be cautious about not putting too much of my available cash into this. That quickly leads you to sort of say, perhaps what we should do is what?
Borrow.
Borrow the money. If we can borrow the money and grow the business and grow the profits, right? So now profits will be spread over the current shareholders. Right? Sounds like a pretty reasonable course of action, right? If we believe in this plan, if we got some spare cash, think about using it. But be careful about selling equity, because that means actually my share of this, even if profits go up, I may end up with a smaller piece of those profits because it's been diluted, right? So the question is, what's the increase in shares versus what's the increase in profit? And if the profit increase isn't equal to or greater than the increase in shares, actually as a shareholder, I'm going to be worse off. And if you say, hey, there's a way that I can borrow the money and we improve the profits per share, that sounds awfully attractive.
So, I mean, this is kind of like when you purchase a mortgage, too. Like, if you get a mortgage for, let's say, 2%, and you can earn 5% on your cash,
right?
That would be part of this.
So it's the same kind of thinking, right? Yeah, so I mean, I could use my cash, but let's say I've got cash tied up in the shares of other companies, and those companies are growing like mad. In other words, the stock value. So you've always got this sort of options to think about. Well, I'll remind you that what was decided last year, the beginning of this year, okay, was that we were going to borrow the money. Right? We're going to borrow the money. And so that'd turn out to be a great thing for the shareholders, because increased profits spread over existing shareholders. You'll love it as a shareholder, and your fellow shareholders will love it. Right? So the last company I was with for 15 plus years, they believed in borrowing the money. Right? They didn't want to expand the shareholder base. So our primary action always was, we've got these opportunities, right? We don't want to dilute the ownership. If this is a good action, we want the full benefit for the current shareholders. So the company's sort of rationale was they were very inclined to borrow money rather than sell equity. Very inclined, if they wanted to grow, could be buying other companies, could be expanding existing companies, very inclined to say, can we borrow the money? Right?
Such a thing as savings?
What?
Is there such a thing as savings?
No, savings the equivalent of that would sort of be, well, first of all, one definition of savings would be paid out as dividend to the shareholders. In other words, we've returned some money to the shareholders, right? So it doesn't mean we haven't done that. But savings would be, let's put it in investment, put it in a savings account, not going to make anything, invest it in another publicly traded company so that it's very liquid, right? And, you know, there are some very successful companies that do a lot of investing. Microsoft is a common example, right? They don't only invest in their own business, they also invest in other companies. So they are partly an operating company and they're partly an investment company. Okay. So, if you had a chance to look at the numbers before we came together for our meeting, you note that the results were not all that we had hoped. You are local people, because we've been southeast region, a lot of people from the community involved in stuff in the community. That's how you came to join the board. Some of you actually are suppliers to us. You provide a lot of the nut product to us, right? So we were one big operating family. So some of you were upset when you learned how the expansion was going. Suppliers were being paid late. What might that be an indication of?
Not enough cash flow.
Yeah, there's cash is tight, right? Well, why would you choose not to pay your suppliers?
Pay your employees first.
You got to pay your employees, right? Right. Otherwise, the government can step in and actually shut you down. But what's the sort of neat thing about suppliers?
Find another one later.
You might be able to find another one later, but even before that...
They depend on you.
Well, they depend on you, yeah. And a lot of our suppliers, we're a major customer for them. But when you owe money to suppliers, do you pay any interest? It's interest-free money, right? Typical terms would be you got 30 days to pay, right? So you've, in effect, got an interest-free loan for 30 days. They gave you their products or service, right? And you don't have to pay for 30 days, so it's an interest-free loan. It's a loan in the form of the goods or services. It's not a loan of cash, but it's a loan in the sense that they gave you valuable goods and services, and you didn't pay them right away. Right? I told you the TWA story, didn't I? Right? That they went bankrupt, and right? So, unhappy. I understand why. Bank was complaining about the deteriorating situation and threatened to cut off credit. So we borrowed a lot of money this year from the bank. We'll see how much in a minute, okay. But what do you think this means to threaten to cut off credit?
Let us borrow anymore.
What?
Won't let us borrow anymore.
Yeah, and that could be a problem if we're having cash flow problems. But even more important, yeah.
I think it could kill the company.
How can they kill the company?
Because if you're having cash flow problems and you can't get more inventory, you can't keep producing.
That's indeed a problem, but there's an even worse problem.
They can call your loan.
They can call your loan. Every loan has covenants to it that said, these are ratios, these are terms that you have to meet. Right? And as long as you're meeting all those conditions, the loan stays into effect. But if you fail to meet a single one of those conditions, they can do something called call the loan. And call the loan means we want the full, the balance of the remaining loan, the money you owe us, paid immediately. Right? So calling a loan, right, is drastic stuff.
What does immediately mean?
It can mean as severe as immediately. I mean, 24 hours. You've got 24 hours to pay us.
Wow.
Right? And we'd have to understand whether they've got any liens against the company. In other words, as part of the loan agreement, did they agree that if you didn't meet the loan agreements, they could take ownership of any assets you had, and they could dispose of those assets, sell those assets to meet your obligations to them. So in the worst case, they shut it down, they sell the assets to which the loan entitled them, right? And you still owe them the remaining balance, but in a publicly traded company, there may be nothing left there, okay? But so calling a loan is a big deal, right? You got to pay immediately. Immediately could be 24 hours. If they wanted to be generous about it, they give you a week to find somebody to replace their funding. All right? So some members of the board, and I won't say who here today, but saying we got to fix this situation or you're out. Remember, you're talking about me. Right? This is a company I founded. I'm the one who invited each of you to serve on the board. We've been in this together. So I understand that you're upset. Some of you are upset with the results we're having. And I know you use the word get rid of you, but I know that's just to get my attention, okay? I know you really would never do that, right? But so everybody knows, there have been some of those sort of intense conversations outside of the meeting. So a solution has been developed. We're bringing in an accountant, Donna Jamison, who is going to be given the job of assistant to Fred Campo, and Fred Campo is the chairman of the board. Fred. Right? So Fred is the chairman. And retired banker, a bank, by the way, that from which we've borrowed a significant amount of money. So Fred has got some dual concerns here. This loan could have, if it weren't repaid, could have an impact on the bank and his stock in his bank. He also, Fred, has stock in this company. So I think it's fair to sort of say he's got double reasons to be interested, and if there has to be a trade-off between those two, who's going to feel more of the pain? Should the bank feel the pain, or should the company shareholders feel the pain? Fred's going to be in a difficult situation. So Fred said he's willing to take some time with the help of Donna to sort of serve as an on-site person to help us get this turned around. And Fred here has said that he's going to give up some golfing days to nurse the company back to health. Right? So Fred, with the help of Donna, is going to give you that. And I'd say as an aside, off stage, that this is a banker, a golfing retired banker, who's going to lead the direction of a snack food company back to health. Do you think this banker knows a lot about the snack food business? Do you think Donna Jamison, a recent accounting graduate, knows a lot about the snack food business? Probably not, right? So this could be, if you were shareholders, or if you were on the board representing shareholders, maybe you would applaud this, or maybe you'd sort of say, that's not the kind of help we need, right? Would you really want, okay, a company headed by, a snack food company headed by a golfing retired banker and a University of Florida graduate, recent graduate? Could be a little scary, right? Could be a little scary. Yes?
Well, isn't it kind of a flag? Because the company was already successful with the current staff that it already had, so it's not an issue of accounting. It's not like, you made a big change, like an expansion. So it's not necessarily an issue of, we don't know how to balance our books right because we're not successful. It's a matter of, another issue, so you don't need to hire an accountant, right?
Yeah,
So
you're exactly right. It's not an accounting issue.
Yeah.
It's a strategy issue, right? And an execution of that strategy
Marketing
issue.
or production or
Right?
something along those
Yeah, so I think Donna is not there for strategy. She's just there to go extract the numbers that Fred might sort of say, well, let's look at it this way, right? And so a banker has a certain way of looking at it. You go into the banker with your financial statements. They'll look at certain things. Mostly they're going to look at cash flow, right? Why are they interested in cash? So are you going to be able to meet your interest payments? And are you going to be able to repay the loan? Think they'd be very good at marketing? No, they probably don't know much about marketing, right? Well, what about producing snack products? Taking in raw nuts, converting them into edible product, right? Probably don't know much about that. What a banker knows about is there enough cash coming in that we're going to be able to get our interest payments to the bank, and are they going to have enough cash to be able to meet the principal payments that they each year? Because you got to pay me my interest, and you got to pay off the portion of the loan, right? So they're really interested in cash flow. But in the sense of cash flow is simply a symptom here, right? The larger problem must be something else, right? That our product isn't selling, or it's not being offered in very many locations, or our marketing campaign stinks, right? Something is going wrong, but it's probably not at the level of a banker, right? But we've just put a banker and a recent graduate to sort of muck around in the business. Will they be helpful? Well, there's an equal probability they will be unhelpful, right? Because they can't deal with the real problems. We don't know what those real problems are yet.
Yeah, they're just there to extract numbers and tell you about them.
Yep. We might be better off. By the way, you as a board are going to agree with this and say it's a great idea or not a great idea, okay? Fred's going to volunteer to do this, and right? So this is where we find ourselves. So what's happened? Remember, last year was 2010. We're now in 2011. Giving you the results of this year, we went from 3.4 million in sales to a little over 6 million. 1 year. By the way, this is where you say, great job. This is where the thunderous applause comes. You got it. See, Thomas has got the idea. Pretty amazing, right? Yeah. I have in one company done something very similar to this, and believe me, it didn't happen easily. Everybody on the team had to do a lot of stuff to make this possible, to generate that kind of increase in sales. Well, at the same year in which we were doing what we've been doing before, doubling capacity, bringing on new retail outlets, right? Launching marketing campaigns, everybody busted their butt, right? And here's the results. COGS, what's that? Cost of goods sold. What does that mean in layman's term?
How much it costs to make the things you're selling.
Yeah, it's the direct cost, right? It's the nuts.
Materials, people doing the manufacturing.
Comes in, gets roasted, gets packaged, right? So it is the sort of direct cost of making the product. Okay? We're then left with gross margin, also known as what? What's another term for gross margin? It's another gross term.
Profit.
Gross profit. Right? So, were we profitable in 2011? If you're talking about gross profit, yes, we showed a gross profit. If you can't show a gross profit, that means for every additional unit you sell, you're probably losing money, right? Because it's costing you more to make it, okay, than you sell it, right? So the first test of profitability is a gross profit. Now, I've actually had companies where we had a negative gross profit. We were making new airfoils for General Electric, and we had not mastered the technology. So every one we made, right, and we even got paid in the early days for stuff that wasn't the final specification, but we weren't getting enough to even cover our direct costs. So every time we cranked another one out, we lost money on it. And the more we produced, the more we lost. Yes?
So there's a near doubling of the cost of goods sold.
Right.
Can we have a discussion about why that happened?
We're going to. But just look at here where our sales are up something like about 80%, and yet our profits went down. So is this the first sort of warning sign? Yeah, there apparently is we had another 2.6 million come in, right? And in a gross profit sense, none of that dropped to the gross profit line. In fact, our gross profits went down. So this is the first sort of point of pain, right? Right? Next one. So total revenue minus cost of goods sold, gross profit, just a reminder to get these terms embedded in you. So now other expenses. What's other expenses? Administration. Can you be more specific?
Interest, tax, and overhead.
Some of that's right, but I'm still looking for more. Some of it's not right. More specific.
Salaries.
Salaries of
Employees, but not.
employees not directly involved in the making of the product, right? Employees, for example, such as?
Us. You.
Marketing.
No, yeah, there's the president of the company, the marketing person, the accountants, right? Salespeople, HR, legal,
R&D.
right? R&D, if we've got any of that.
do nuts.
Right? So that, all of that is, quote, other expense. So other expense is up, right? It'd be interesting to calculate how is it in relationship to what, the growth in sales? But we would hope that we would not grow administration as quickly as we grew the sales, right? That there'd be some moderation in that. Then, well, EBITDA. By the way, this is another one of those terms that is thrown around. Right? So this is not a made-up number, and it's often just written that way, and people talk about it. So what does that stand for? Go ahead.
Earnings before interest, taxes, depreciation, and amortization?
Amortization. So excellent. Okay, so it's earnings before interest, taxes, depreciation, and amortization. So it is sort of saying, before we take all those outside things, like do we owe money to the bank, do we owe money to the government? So this is sort of our inside earnings. Then we've got depreciation and amortization. Well, what's depreciation?
Your assets.
If I buy something that has what?
A lifespan of.
Life more than a year, right? So something that has a multi-year life, when we buy that, we charge ourselves a fraction of that each year, right? And that is our depreciation. And over the life of the asset, right, we depreciate it. Piece of equipment would be the best example. Piece of equipment might be anywhere from 3 to 6 years. We'll talk more about depreciation later on in the course. If you've got a building, you might depreciate a building over 30 years, right? Has a useful life. So that's depreciation. Now we got this other thing, I'll just mention it briefly, amortization. Depreciation is for tangible things like buildings and equipment. Amortization is for intangible things. Right? So hang on here. What's an intangible thing? Suppose I buy another company and I buy it for more than its book value. Assets minus liability, book value. Let's say the book value, it says it's $1 million, and I pay $2 million. Right? So I've, quote, paid more than its book value. Right? I don't want to say I've overpaid, but I paid more than its book value. That is intangible value. I don't know why I paid it. I don't attach that extra money to anything. It's intangible. For example, it might be because it's got a great brand value, right? Whatever it is. So then if we're going to write that off over a period of time, writing off an intangible is amortizing it. Right? If we're writing down, in other words, if we're expensing a tangible item, we call it depreciation. If we're writing down an intangible item, we call it amortization. Yes?
This was referred to as goodwill. When I buy a fancy brand.
That'd be another term for it, yeah.
Okay. And now that line when it appears, I don't want to take away from this. That is not amortization. That is just simply a declaration of how much you paid for goodwill.
Yeah, but then you can begin to amortize it.
Okay.
Right?
Understood.
Right. So you start with this amount, and then you can begin to amortize. Just like you bought this much for a piece of equipment, now you begin to depreciate it. Okay. So then we get down to EBIT. EBIT is what? Earnings before interest and taxes, also known as
Operating profit.
operating profit. So this EBIT is, again, you'll hear it thrown around. What's the EBIT? Right? They're talking about your operating profit. Tom?
The numbers in parentheses are those negative numbers?
That means it's negative, yep. Yep.
So we're missing brackets? We're missing parentheses around 116, 960? No.
That's the amount they're subtracting.
So gross margin minus expenses gives us a negative. Now we add in the depreciation. So when you add,
Everything's being
calculate this, yeah, I mean, all the expenses in effect are negative, but the ones that, if you're doing pluses and minuses as you're going, note here we showed this as a plus, right? Just it's an expense, so we didn't show it as a negative, right? So that's just how we show things. Operating income, operating profit. Now we're ready for interest expense. Why do we keep interest expense separate from all the other expenses?
compared to companies. You don't really care how much they're.
Yeah, because it's a question of how we finance the company, right? If we borrowed money, then we're going to have an interest expense. If we sold stock, then we're not going to have, that expense. So it is simply to separate the operating of the company from the financing of the company. Right? Separating the operating of the company from the financing of the company. So we're then left with interest expense of $266,000, giving us earnings before taxes of a minus 106. But wait a minute. Interest expense. So we lost $266,000. Right? We lost $266,000. But our earnings before taxes is only a minus 106,000. Wipe that out. Interest expense 266 means our earnings before taxes are a minus 106,000, right? We lost 266,000. Taxes we show as a negative 106,000, giving us a bottom line of 160,000. How can we at the bottom line lose 160,000, but before taxes we lose 266,000?
The refund.
Everybody hear that? Under U.S. tax code, there are circumstances in which the government will refund prior taxes.
That's still, the parentheses are still messing with my head.
Yeah, well...
Just because just math is math.
So, note, earnings, if earnings are negative, it's shown as a negative. Earnings, negative. Earnings, negative. Right? Expenses are not shown as negatives, but earnings is a calculation, is the best answer I can give you. And when earnings are negative, it's shown as a negative. And expense is not shown as a negative, but earnings are shown either as a positive or a negative.
When
Yes?
the government refunds you $106,000 or whatever figure that may be, are you then taxed on it later?
No, the answer is no. So we'll talk more about this later in the course, but the answer is if you have a loss, there is in U.S. tax code, not necessarily anybody else's tax code, a carryback provision, which means that if you paid taxes in any of the 2 prior years, you can go back and get a refund of those prior taxes up to your loss for this year. Right? So, I mean, so what you're owed for this year. So this could either be a claim against prior year profits, 2 years prior, or it can be that your taxes will be, if that doesn't cover the entire loss, then in fact you can carry forward that loss to offset future taxes. So there's a carryback provision and a carry forward provision. You'd first of all use the carryback provision, if it exists, to get some money back from taxes you previously paid. And if there's still a loss, you would use that to offset your taxes in the future. So why does the government do that?
Because economy.
Yeah, or...
So it helps balance out boom and bust cycles.
Yeah, it's a business-friendly move, right? It's a business-friendly move. And, hey, we're partners in this, right, in some sense, right? We need businesses that are healthy. So, but would this be true in Europe? Would this be true in China? Would this be true someplace else? Not necessarily. This is a function of the tax code. This is a tax provision. It is business-friendly. It probably costs business a lot of money to get this into law, right? And they probably fight very strong the Chamber of Commerce to keep it in here, but you have to admit that it is a help to businesses to get some of that loss covered by previous taxes or by future taxes. So here the assumption is made. Note if you calculate this, it's 40% of this. Typical sort of tax rate, okay, is about 40% in the U.S. So this is basically sort of saying we're going to get 40% of that loss back either by a refund of prior taxes that we paid or by a reduction of future taxes.
Well, judging from last year's taxes, we paid about the same thing for many years in a row.
Yeah, so 40%.
We've gotten our, well, $58,000 right from last year, so we've gotten almost it all back. We've gotten...
You get a big chunk of it back, yeah, immediately.
Okay, but I'm
you
saying...
offset that. In other words, yeah, we lost $260,000, but we got a refund of $58,000 from that year. Was there some things here? So we take full credit either by back taxes or by minimizing future taxes. We're going to get 40% of this loss is going to be covered by tax effects. Right? So this is how we really lost 266, but we're only going to show losing 160 because there is tax benefits from losing money. That's a function of the tax code. But everybody understand why we may sort of say, well, we lost 160. No, you really lost 266 in an operating standpoint, right? But there were tax benefits to be had here. When I take advantage of those tax benefits, the loss is reduced to 160,000. Yes?
Okay, so that move makes us hurt less, right? But we still have to address the 266 loss.
Well, we still got problems, right? We're losing. We've lost a ton of money, whether you like it or not, right? I mean, it's nice that the tax effect offset the loss, but the loss is still there, right? And if losses continue at that level, we'll soon use up any potential tax benefits to be had here, right? So I'm just explaining the effect, but it doesn't take away from the thing that we increased sales by 80% and lost money, where before we made money on a much smaller volume. So, this year. So what do you find most encouraging? Oh, Thomas?
Yeah, so are we doing conservative depreciation?
Are we doing? Great question, but what do you mean by it?
Well, because if we're doing non-conservative depreciation, that depreciation expense is going to go down each year.
Yeah, so depreciation is what is the useful life of the equipment or the useful life of the building, right? And we're going to talk a lot more detail about depreciation going forward. One quick answer to that is that for tax purposes, the government tells you how you must depreciate things, how long, right? And they give you certain options as to how quickly you depreciate things, right? That is only for purposes of calculating your taxes. You can use a different depreciation method for what you report to the general public.
Yeah.
Right? So let's just presume for our discussion here that we're using pretty standard depreciation. But what would be the effect of this? Think about depreciation. Is that a cash expense? No, the cash was when we bought the equipment or improved the building or whatever, right? So this is a non-cash item, right? So when we get to our real worry in a little bit here, which is cash, how we depreciate it isn't going to make any difference because that doesn't have any effect on our cash flow. The cash flow came with the actual concrete action that we took. Right? So we could, if we could alter the depreciation, right? Well, let's suppose it were possible to show less depreciation. That means we'd have less of a loss, right?
It's good, but...
No, it'd be less of a loss. In effect, then we'd have fewer federal tax benefits because there's less loss to be covered by previous things, right? So you can appear to lose less money, but that means the federal tax benefit will be worth less. So it's a great area to probe, but there's pros and cons either way. And we'll do some examples of that later in the course.
Then I guess my question would be about the other expenses. Like, are some of those going to terminate soon? Like, is our marketing campaign going to end? Maybe it takes longer for it to affect. Because
so now we're into the sort of marketing thing. Have you taken the marketing course?
No.
It's a great course. Take the course, even though I don't teach it any longer. But so how does marketing work? Marketing is trying to get people to buy stuff, right? Initially, it's very, very important for new products because people don't know that it exists. So you've got to at least make them aware that it exists. But are most things sold because of marketing? No, the answer is most things are sold because of word of mouth. People try it and like it, or they look at somebody who they trust who has tried it and they say it's good. So there's marketing versus word of mouth, okay? And the purpose of marketing is simply to, in some sense, to start the fire, right? You've got to somehow get people to try stuff. So you use marketing intensively for a short period of time, and then you depend upon people who've actually tried it, and they'll buy it again or they'll recommend it to their friends. That's called word of mouth. So you're exactly right that we would hope over time, initially we've got to spend a lot of money on marketing just to get an awareness out there, right? But then over time we hope we can cut back on marketing because word of mouth takes over. That's for free. You don't even have to take $50.90. We'll give you that much for free. Yeah.
So this question will take us in a different direction, and I apologize for that, but I'm really intrigued by what you said about marketing. Mm-hmm. And I wonder if it's specific only to a certain type of marketing or business. Because when you think about advertising ads and jingles, the psychological effect of those things on people, I think, is pretty profound. Mm-hmm. So I would be interested in doing a little research on, is that different?
Yeah, feel free to do that. The marketing process actually breaks down into various stages, okay, starting with awareness and then trial and other kinds of things. So I was talking in a very large sense, okay. Marketing is good for getting people to be aware and try it, okay. But long term, you can't afford that marketing expense for everybody. At some point, you have to depend to a large degree upon the persons who bought it like it, and they'll buy it again. In other words, repeat purchases. And then secondly, by reference, that word of mouth, that they will hear about it from other people who are very, very happy. So either repeat purchases or referrals, right, are really what drive most things.
So,
Go ahead.
so that would be a form of persuasion, right? Word of mouth and referrals. You got to go see this person, or you got to try this product. It's really great. I tried it. I like it. That
Yeah.
would be a form of persuasion. So that would be then my interest. Are there forms of marketing persuasion, like advertising commercials and such, that are
Well,
so
there's,
manipulative?
free giveaways that give you free trial, whatever, right? But that would launch us into marketing.
Exactly, and I apologize.
No, it's a great question. All right. So what's most encouraging here?
Sales increased.
Sales increases, right? I mean, that, our basic premise that, hey, we could expand nationally and we could sell this product elsewhere. Pretty dramatic evidence of that. In 1 year, right, we've grown sales that much. Been no opportunity to do that within that kind of 80% increase in 1 year within our existing region. So that's highly encouraging. So what's most discouraging?
The cost of goods sold.
Yeah, or the gross margin if we want to.
Gross margin, yeah.
Yeah, so the fact that we sold all this extra product and didn't have any additional margin out of it, very discouraging, right?
Well, it could mean several things. I mean, if you think that the price that we're selling our product of is constant, this is discouraging. If you're thinking that, like, as a strategy entering new markets, we lowered our price just to get awareness, get people to try it, then it's not that discouraging.
Yeah, so you're sort of saying this shouldn't be translated as units sold, right? It's units sold times price.
Yeah.
So we really need to break out that sales number into units and price, right? Because it may be that we bought our way into this market by offering it at 30% price reduction, right? So what seems like a big revenue increase was simply because we lowered our price so much, and maybe we've even almost lowered it to the point where we'd be losing money on every sale. We're not close to that, but not too far away from it, right? So we need to great observation, you need to break it up in terms of quantity versus price. Okay. So at this point, this is all you know at the moment. What would you do? Nathan?
Well, I'd look deeper into the cost of goods sold and get more details on that, just because, like you're saying, depending on the price point and where you're selling.
Right.
So, are you taking, so the new factory, if you expanded your factory, does that mean that, your productivity has gone down and then you're paying more towards your laborers to, make that product? Is it not going as well as it was before? So there's just a lot of questions on figuring out how does that cost of goods sold, in order to produce that go down? Does your supplier, did they know you're expanding, so did they increase their price? So is there a way you can bring that price down? So just a lot of unknowns in that section.
So all good points. Okay. Anybody else?
I guess I'd also want to look at sales and look at those two things, sales and cost of goods together.
Nathan, I think, sort of mentioned that in his list, yeah. Well, thank goodness none of you sort of said at this point you'd fire the president. Okay, so I've at least made it this far through the meeting, right? None of you sort of said, hey, I don't know what it was, but management is in charge of this, and, it's a fail for whatever reason because they had a crazy new pricing policy, or, they did something, they mucked this up big time, and this is a huge fail, so let's have a private board meeting to talk about whether we can depend upon the management team, right? Would anybody here ask the management team to step out and have a private meeting of the board to say, what do we do about the management team? Or are you all management team must still be great. We're going to hang in there with them another year. Nathan?
Well, I think it's too soon to tell, so that, like, you know, you could tell them,
Thank you.
hey, here are our suggestions.
Right.
Would you be able to, you know, sorry, I lost words. Would you be able to, like, you know, do these suggestions and see if they work and come back to us with numbers? And if things have changed, then we know either the suggestions are working, or if they just don't do the suggestions altogether, then you have a management problem because they're not listening to
So
us.
how long would you be patient?
Depends on, there's no real answer. It's how long are you comfortable with it, or how fast do you think you can
Would
get
you wait
those
another
numbers
year
changed?
to see how things work out?
I would wait another year, because you have suggestions in order to implement those in order to change. Because it's not the management directly. I mean, unless the management is causing those cost of goods sales to go up, because they're telling them, all right, now we're so large, just do whatever it takes to get the product together. Then
So what
you've got
about
a
if the
management
bank
problem.
you knew that the bank was very close to calling the loan? The bank sort of says, we're really uncomfortable, right? And we're going to have an executive meeting of the bank board to see whether we're going to call this loan. We as the bank have lost confidence in the management of this company. So, board, do something about it. There's stuff, I mean, there's some substantive stuff that I'm sure you'll want to address. You're more knowledgeable than we are. But clearly, management has failed, right? So, if you step up to the management problem and you convince us that you know what you're going to do in a substantive way, we won't call the loan. We'll give you another 6 months. Would you?
Well, how is it clear that the management's failed? What information do they know that the management has failed?
All the bank knows is it hasn't gone well, right?
Well,
and the bank.
I would tell the bank it's not management's fault. Here are the numbers.
It doesn't matter. It doesn't matter. If the bank calls the loan, we'll see how much what the size of the loan. But if they call the loan, you're in deep and serious trouble. So the bank doesn't have to be rational. All the bank has to do is have the power to call the loan, right? They can bring you to a halt in a big hurry. Well, why did we put ourselves in this position?
Right, yeah, that was
we put ourselves in this position because we wanted to take the gains and spread them over the same number of shareholders. So we sort of said, hey, let's borrow the money. You've now sold some of the control, given some of the control to the bank. And if you just borrowed a little bit of money, you've only given up a little bit of control. If you borrowed a lot of money, then you've given up a lot of control. And at some point, when you owe the bank a lot of money, they own you. Real life story. We were looking to consolidate a particular industry segment to reduce the competition so there'd be less competition. So we were going to, basic strategy, we were going to borrow a lot of money. I think it was like $300 million to buy up a series of small companies that were a little market by themselves. And the bank, our bank, which had been our bank for over 40 years, was really antsy about this, really nervous about this. They didn't believe it was, because we were going to borrow a lot of money from them to do this, right? And the person who was the CEO of our company at this point sort of said, well, we'll just change. I was on the airplane when this took place. The bankers are there on our plane. Here's the CEO. And after a while, he had enough of this, and he sort of said, well, I understand your concerns, but we'll just change banks. Right? Fine. Wow. When the chairman of the corporation found out about this, right, that we had said to the bankers, we don't need you any longer, right? The CEO was gone within the week. Right? When you owe the bank a lot of money, they own you. Right? Don't piss off the bankers. Right? So when you owe a lot of money, somebody owns you to a small or a very large degree. In our case, we had so much borrowed money that in fact the bank owned us. right? It'd be very difficult to replace that banking facility with other banks, right? The chairman of the corporation knew all those times over the previous, since 50-some years the company had been in existence, where the bank had stepped in to help out the company when times were tough. The bank was there to lend the money. Okay, there was a long-term relationship. And when some young new CEO was going to come in and just sort of said, wipe all that aside, right, he didn't understand how business operated. Somebody? Yeah.
Just back to this, with the 2011 numbers, how different is this than the predicted 2011 numbers? Because we knew we were doing this expansion. What were we expecting to happen as compared to what did happen?
Did you read ahead or something? It's a great question. It'll come up later, but he's sort of saying, what was the budget? What had we predicted for the year?
Maybe we expected to take a loss in the first year, and if we can say we're right on track with what
Maybe we had even expected to lose more than this the first year.
Good thing.
Right? Remember, this is probably going to be what, a 4 or 5 year plan? You think you're going to be completely effective in getting people to sell your product, getting people to try your product in the first year? Or do you think that's something where it's going to take a while, okay, to get new retail outlets to carry your product, and going to take a while for people to try their product, and then by their being happy and they're recommending it to others, that first year isn't necessarily indicative of second year, third year, fourth year? So Thomas very brilliantly would sort of say, what was the budget for the year? What did we approve for the year? Could, in fact, this actually be less of a loss than we had budgeted? Well, then your reaction as the board should be quite different, right, than if we sort of said, hey, we were actually going to show an improved profit this year. Right? We were going to, for example, did we show we were going to double our profits this first year? So another standard is, what was the budget? Because you bought into the budget, whatever that was. Right? You approved that as a board. So maybe management actually, this is still a tough situation, but maybe management did better than budget. Right? Or maybe they did very much worse than the budget. So that would be another data point, an important data point. You agree? Yeah, so we'll come back to that one. But great observation. That's why we have budgets.
So I wanted to go back to what Nathan was saying before you introduced the idea that the bank was upset and might call the loan. I liked everything you said, and I think from a management perspective, I would want to actually call the managers in to work with the board in maybe a more affiliative way than kind of say, give me these numbers and tell me what your thinking was and show me this. To me, if we're actually in a crisis, bringing people in and trying to plot it out together so everybody has a larger understanding, in my thinking, would be a nice way to proceed. And then if the bank was upset, that's another piece of data to be able to give them, that we've actually sat down with the managers and we've talked about this. We understand it in this way now.
So now think about, we've got a board of 11 or 12 members here. And let me just sort of say, if you make this into a group project, right, you're going to have 11 different opinions, all well-meaning. These are people who are here for a day-long meeting. Maybe they'd extend it to a 2-day meeting, but they're not employees of the company. They're here for a limited period of time. This is a question that's going to get addressed within that time period, right? This may be the reason why they said to Fred, on behalf of the board, maybe the board might want to add a member or two to that who were in a position to be able to volunteer some more time. But just say from my own experience, if you put it to a board this large, okay, it would be chaos. I've been on lots of boards, and even on boards with just 5 or 6 people, asking them to take over these kind of things in a real sense, not asking good questions and maybe providing general direction, but to ask them to get involved in the actual mucking of things, and very specifically, this is what we're going to do. a challenging task, right? I don't disagree with the sentiment you're expressing, but in many situations it wouldn't be very practical. The group hug, the group let's solve this together. Nonprofits will do a lot of that, but profits, and where there's a local board, will do some of that. But
I would be a little uncomfortable circumventing the CEO's position, whether or not I was entirely confident in that position or not. I would still want that position to function as it is. So for the board to sort of to go around and it feels like, well, at that point, then you might as well get rid of the CEO.
yeah, well, that question's going to come up again, but you're exactly right. Right? I mean, provide whatever guidance you want to the CEO, but then support them 100% when you agree with what they're going to do. When you've lost confidence in the CEO, then you need to do something, right? But don't leave somebody in charge who you don't have confidence in. Okay. By the way, another thing we might want to look at, earnings by industry. How much money you make is a question of the kind of business you're in. Notice drugs and medicines, 22%. Sales, net income, profit, 22%. The sort of generic companies that I had, in a good year, we'd make 6 or 7%. In really tough years, we'd make 2 or 3%. I don't know if I told you this story or not. I told you we were a profit-sharing company. Did I tell you that? Huh? I did, yeah. We were a profit-sharing company, so we get the employees together once a year with their spouses, okay, and we'd give them an annual report, and we'd go through it, and we'd go through the numbers, okay, at a fairly high level. And because they got 10% of the profits, so we wanted them to sort of understand that. So as part of this, the stick of this, as we'd introduce that thing, I'd ask people, what do you think for every dollar we sell, what do you think is left over after we paid all our bills? Right? Asking, what's the bottom line look like? What, out of a dollar, what do you think is left? Well, it's not uncommon for people to sort of say, well, I think you'd have a quarter left. You'd have 25 cents left for every dollar you sold. Right? Some are even higher than that. Nobody came up with a number less than like 10% or something. Okay, they thought every dollar you sold after you paid all your bills, you'd have a dime left. Right? No, they thought it was pretty easy to make a profit. Right? In fact, we were making somewhere in a really good year 8 cents to a dollar. Right? And in a typical year, more like 3 or 4 cents to a dollar. And in a bad year, we actually lost pennies on every dollar we sold. Right? So here, drugs and medicine, for every dollar of sales, 22% to the bottom line. Food, 1.9 cents. Less than 2 cents of every dollar. Right? So these food stores, supermarkets, have to be tremendously efficient, right? Okay, to eke out a profit, very, very hard to do. Okay, so last year, 2.5, this year, a minus 2.7. So we went from making 2.5 pennies out of every dollar to losing 2.7 pennies out of every dollar. Just another perspective on this, right? So just think about that. People sort of say, well, what about if we gave people a 5% increase? That's not much. Question is, what's that going to do to the bottom line? Right? When there's only 2.5 pennies to begin with. Now we got to sort of say, well, what portion of our costs are employee costs? And what would a 5% or what would a 10% do to the bottom line? But when we only got 2.5 pennies there to begin with, it doesn't take much in terms of pay increases, suppliers increasing their price to you, utility expenses. Right? It doesn't take very much to overwhelm that 2.5 pennies. Right? Now some other industries, other companies, maybe they've got a nickel there, maybe they got 5 pennies there. But believe me, that for a lot of companies, you're dealing with a very low profit rate. And you're fighting against all those other things that suppliers who want more, the government who wants more, right? All those things for cost increases. Right? And of course, your customers aren't happy to have you increase price because a lot of times we can find someplace else to get this. We don't need to pay you more if you're making a generic kind of service or product. So this is not an easy matter. So look at this company. 2.5 cents. Lose 2.5 cents for every dollar. Okay, a quick, let's take a break. Otherwise I'll just rattle on too long. So there's another statement that we won't spend a lot of time on. We talked about income statement, balance sheet, and what? Income statement, balance sheet, and cash flow. 3 biggies. There's another one that's often called statement of retained earnings. Okay, so retained earnings, what's the clue they're giving us here?
Doing with your retained earnings?
Yeah, if it's retained, it means you didn't do what?
Pay dividend?
You didn't pay this stuff out as dividends. And this number is for this year or cumulative?
Cumulative.
Cumulative, right? So this is cumulative retained earnings. So which financial statement are we on? The balance sheet, right? And so we've got this sort of key number on the balance sheet called equity, which at one point we can think about as equity equals assets minus liabilities. But we can also say equity equals what? Something plus something. Retained earnings and
Assets.
Common stock. Right? Money raised by selling shares. Right? Where did we get this equity from? One view of equity is we got it by assets minus liabilities. Another view is we got this equity by selling shares and retaining earnings. Right? Those are 2 different views of equity, book value. It's assets minus liabilities. It's also it's also stock. In other words, we've sold ownership plus retained earnings. Now, there's several forms of stock that we'll talk about, but just think about a stock in general. We've raised some money by selling equity, stock, right? And we've raised some more money by retaining earnings. That gives us our equity, and we use that equity to support assets minus liabilities. That is the difference between assets and liabilities.
Equity is also cumulative, always. I know retained earnings is cumulative, but it's equity.
Equity is, I think I know where you're going. Remember, it's at a point in time, and the question is, how do I get this equity? One view is I've sold ownership,
right?
And I've retained earnings.
Some sales money, right?
Not sales money, retained earnings.
Okay.
Right? And on the other hand, I got this equity by having more assets than liabilities. It's 2 different views of equity.
But so your total equity...
One is, how did you finance the equity? I financed the equity by selling ownership and retaining earnings. And how did I use the equity? Assets minus liabilities, to cover the difference between assets and liabilities. Well, right?
So equity is so if your company, you've been in business for 50 years, and when you were a startup, you had a venture capitalist give you $20 million. Your equity after those 50
They didn't
years,
give you that.
No, you sold that ownership.
I sold ownership to them.
So it is
right?
cumulative. And
Nobody gives anything in business, right?
So if you took out loans to buy assets,
They go into the liability column.
So they're not part of your equity.
They're not, well, they influence your equity. In other words, what did you do with those loans? You bought assets, right? So you got assets minus liability, gets you to equity. That's one view of equity, assets minus liability. But another view of equity is it's selling ownership plus retained earnings. One is how did I use it, and the other is how did I finance it? Where did that money come from? Where did that equity come from? It came from selling ownership and from retaining earnings. What did I do with it? I bought some assets, right, and incurred some liabilities. Okay. So, as of the end of 2010, first year we showed before, we had retained earnings of $203,000. Does that mean that's the profits we had from day one, from day zero? No. It's not our total profits from day zero. It's what? The profits we've retained since day zero. Right? So we've retained $203,000. Now what about this year? Our net income was a minus $160,000. So that's going to consume some of that retained earnings, right? We're going to have less retained earnings now because this year we actually don't have any earnings to retain. Actually, our earnings are negative. So they're going to draw against that retained earnings.
And a dividend.
And we're also going to pay some dividends. Now, in the details here was that this company has typically paid dividends of 22 cents a share, right? The proposal is that we cut dividends in half this year and only pay 11 cents per share dividend, right? So we've got 100,000 shares currently, right? So it's going to cost us $11,000. So that's going to further draw down this retained earnings by paying dividends, right? Giving us retained earnings of $32,000. What are your thoughts about this? Paying a dividend a year in which you lost money.
Shows that you have faith you're going to make money in the future.
I got a question. What if you had really, really low retained earnings? What do you do then? I mean, how would you pay your shareholders?
How would you?
What would happen in that scenario?
What would happen? What would you do?
You have to pay out of your stock.
What?
You have to pay out of the money that you got from stock.
You could do what? Sell some more stock.
If you don't have cash, then
You could sell some stock and use the money from that stock sale to pay some dividends.
you have to pay dividends.
Right? Well, remember, that for some reason they want to pay dividends. We'll come back to that. Right? Or you could, what, borrow the money to pay the dividend?
Haven't you already?
That's what our company did.
Okay.
Right? So I was on the board of the holding company, right? So we lost money one year, and the chairman, of this private company, right? They paid dividends every year, right? Chairman recommends that we pay dividends again this year. But I said we lost money. And he said, not a problem. And I said, we don't have sufficient cash to pay it, right? But you still want to pay a dividend. Right? He says, that's right. He said, the bank will loan us the money to pay a dividend. Right? His argument was, who were the shareholders in the company? And this is a 50-year-old company, started with a forging company. And the shareholders were primarily people who had helped build the company, or they were the widows or spouses of people who had built the company. And these people had come to rely upon those dividend payments. They were part of how they supported themselves, right? And he said, I feel an obligation to continue to make those payments, even if we have to borrow the money. He didn't even talk about cutting it. He sort of said, people have come year after year, they've built their lifestyle, they've built their retirement, right? They've built their nursing home payment on getting that dividend check. And he said, even though we've lost money, my recommendation is that we pay the historical dividend. Even though we're going to have to borrow the money, and I've talked to the bank and they'll loan us the money. Right? So he argued for, and I was shocked by this. I could not imagine paying a dividend in a year in which you lost money. Right? But from his perspective, this was sort of a obligation that he felt was important. He had an obligation to current shareholders, since it was primarily a dividend company, was an important part of why they owned this stock, and it was, part of their being part of the people who had built this company to continue paying that dividend. Right? And he paid that dividend up until the day that they went bankrupt, and eventually they went out of business. Right? Because he felt he had an obligation to do that, even if it meant borrowing money. For me, I sort of went like this, like, hey, that doesn't sound like good business to me when you lose money to pay dividend. Okay, so the proposal here is to cut the dividend in half from 22 cents to 11 cents, even though they've lost a good amount of money. Right? What's going on? Somebody sort of said it's sort of trying to send a signal that while things were tight this year, we still have confidence in the future, so we're still going to continue to pay a dividend. So that was part of the argument that I could make to the board to justify the 11 cents. Another part of it I could, another part of it I could sort of say, this is $11,000, right? The cost of paying an 11 cent per share dividend is $11,000. I've tried to give you the sort of benefit of it to offer a little bit of encouragement to the shareholders. Why would we spend our time talking about whether we should spend $11,000 or $22,000? We've got bigger problems than this that we have to solve. This is actually a distraction, right? Intended to send a small positive sign to the current shareholders. But in terms of, just look at the absolute numbers. You've seen all those other numbers. We were talking about millions in sales and other stuff. And why would we as a board spend any time worrying about whether it's 11,000 or 22,000? Surely there are more important things to focus on while we're together than that number. Right? Could we save $11,000? Yes. Would it make a difference in the grand scheme of things? Absolutely not. So why are we wasting any time on it? Could be what?
Establishing like a value to
well, we can look. Yeah, we can look at what the stock price, what's going to happen to the stock price, and we will. But I'm trying to sort of say you have to look at all these numbers in the context of where should we be spending our time. We noticed up in the gross margin that hey, we actually sold millions more and had less gross profit, less gross margin. Do we need to dig into that? The answer is absolutely yes. That's a huge effect, right? Huge effect. So as a board member, you've got to figure out where to prioritize what you want to focus on. And as a chairman of this, just trying to get through the meeting, would I be glad if you as the board member spent most of the meeting talking about whether we paid the $11,000 in dividend? Because it keeps you from focusing on other areas that, it's easy to understand, right? Easy to understand, but it's inconsequential. But if you want to waste the board's time doing that and give me authority to keep on trucking, I'll do it. I'll let you talk about this till the hell freezes over. But you've misdirected your attention. So as a board member, you got a very limited period of time. What are you going to focus on? What are you going to focus on? Where's the heart of the matter? And as you become more more experienced in financial statements, whether you were thinking as an investor, what are my questions, or as a board member, or as a potential employee of this company, I see the numbers. Where do I want to ask some questions? Right? How do I determine where to focus my attention? It's not here. In this case. Could it be in some other case? Absolutely. But here is not where you should focus your attention. Okay, everybody understand at least the arithmetic of this? Okay, good. All right, so let's go to the balance sheet. By the way, we're going to be on this case study for a couple of weeks, maybe 3 weeks. So you've raised a lot of good points. We're going to come back to many of those, okay? But I want to get you immersed in the case. All right, so balance sheet, cash. We had $57,000 at the end of 2010, or we can say at the beginning of 2011, same number. Right? And at the end of 2011, we had $7,200 in our bank account. Big deal, little deal. Shannon, what did you say?
I think it's kind of a big deal.
Why?
We're just not knowing where it's going. I think we just need to reinvest it. It would be a flag for me.
So what did we say how many dollars came into the company a year? Coming in now? 6 million in rough numbers, right? And how many production days would there be per year? Let's make the numbers easy. Let's say there's 300 production days. So that means, and by the way, what we've got, so what is that per day? It's about 20,000 per day. Right? We've got expenses that are totaling up to about 20,000 per day. So how long is this $7,000 going to last?
Hours.
About 3 hours.
Yeah.
Payroll, suppliers, the bank, utility company. When you're out of cash, you're out of business. So, what's our number one problem at this point?
No cash and the bank won't give us more.
Cash is our immediate problem. Right? So, what are we going to do about it?
Frank Capo to give us the loan.
The bank, you said? Or
Frank
some?
Capo.
Huh?
Frank Capo.
Oh.
Yeah, the chairman guy. Retired banker. Put up $50K.
If you were a banker, if you were Fred Campo, would you loan this company more money at this point? Do you think this is a good candidate for getting a loan from anybody other than the mafia? Remember, the bank is concerned enough that they may not get paid what they're currently owed, much less to give you more money. So I don't think, remember, we're down to hours now. Right? We're down to hours. So while we borrowed a lot of money, it'd be attractive to sort of think we could get the bank to give us some more money. And by the way, perhaps they might if we threaten their very existence. And no, literally. But if we're small potatoes, do you think they're going to put more money at risk? Probably not if they want to continue to be bankers, right? So let's for the moment set them aside within the sort of 3-hour window we have and sort of say, going to talk to, and nothing happens that quickly in the bank world, right? You can go have a conversation, but it'll probably be maybe weeks, maybe a month or longer, given the situation that we've got here before they'll give you an answer. We've got a limited period of time. So let's set the banks aside for the minute. Where do you go next?
Suppliers.
Suppliers, I mean the people that were now like 60 days behind, 75 days behind, and
I'd go to them and
say, lend us some money.
No, I'd say, look, we're about to go bankrupt, and that's a threat to all you guys, so we want you to give us a longer term. Give us
Well, they're already giving you 60 days when you said you would pay them in 30 days. So this is like the TWA situation, right? It would probably depend upon, hey, whether they had other customers for their products, right? And remember, we've got them because we produce a premium product. That probably means premium nut products coming in. So they probably, and you'll find some more facts a little bit later on we'll talk about, that say they're probably not a candidate for giving us more free product, right? They've given us enough free product. They've got other places they can sell it, and I'll tell you why. Let me just sort of set that aside. So we can't go to the suppliers, although that's one place you could go and just say, hey, what about if we don't pay you for another 60 days? Thank you for continuing to keep us in business. So where else do you go?
Shareholders?
Bingo. Right? Who's in a position to reach in their pocket in the near term, right? They can either buy more shares, your shareholders, and the other shareholders are going to take clues from you because you know more about this than they do. So we'll start with the board. Are you prepared to buy some more shares or to loan us money? So by a show of hands, how many of you, if you were sitting in this situation, 3 hours of cash, company losing money, right, would be willing to put more of your money at risk, either in the form of a loan or in the form of more shares of stock?
Back to Thomas's point.
I've already done that at an occasion.
You've done it before?
Yeah. So
And you do it again?
Yeah. I mean, it turned out great that
Okay.
time. But I, as an employee, though, I was the company and a shareholder, and I knew the future prospects, and I believed in it, and I did it.
Okay. So you're not an employee.
Well,
In this case study, if you were a shareholder in this company, from what discussion we've had so far, would you loan the company money or buy more shares?
I think I would, yeah.
Because understand, if we don't get you all to provide some more cash for the company is apt to do what? May go bankrupt. Certainly would have to put itself up for sale, right? Have to put it up for sale. But it would cease operating as a sort of going concern for a period of time. And what you don't know is what your current stock would be worth, right? So by not being willing to help at this point as a board member, the company is probably going to be left with no attractive alternatives, and you're going to put whatever investment you've got in the company at severe risk. So I've been here, done this. This is tough going, right?
Double jeopardy, right? It's all or nothing.
Well, you wouldn't put money in unless you had a plan that you believed in, right? In other words, why throw good money after bad money, right? So you'd want to know something about the plan, and we don't know that at the moment. We haven't come to that conclusion. But I want you to get a sense that in this situation, right, cash is the most immediate crisis we have, and it's so desperate that probably the only source of near-term cash is to get the board to step up to it, to provide enough cash to buy enough time to explore other options. New bank, sell some stock to other shareholders, sell some stock to new investors, and how much are we going to get for those new shares, right? Put the company up for sale. All of that requires time. I've done all of those things. But you've got to keep going for a period of time. You've got to buy a period of time. And that's either going to have to come from the current bank, who would like to save the investment they've already got, and if they believe your plan, maybe they'll put more money at risk rather than lose their entire current investment. So, but you only got the board and you've only got the bank. Those are the people that are right there who will talk to you. So remember I talked about the bank owns you? Right? If you want to go back to the bank and say, hey, I need more money, I think in order to get through the next 2 months to explore other financing opportunities or sell the company, I need 2 months or I need 3 months. So here's the extra loan that I need. You can do that. And the bank will do its calculations whether to believe you and fund you or not believe you and not fund you. And the board members will either buy in by reaching in their pocket, or they will walk away, right? And say, I wish you luck, and I sure hope my shares are worth something, right?
You can't sell your shares, right?
What?
You couldn't turn around and sell your shares.
If this is publicly traded, sure you could, yeah.
Okay.
If you're publicly traded, yeah, you can sell.
So if you know who all the board members are and they all start selling,
Yeah, and send a signal to the market, yeah, that you better bail out of this, which is sure to bring its downfall, right? Because insider trading has to be reported, so.
That's what I was thinking.
Yeah.
That's why you couldn't sell it, because it's insider.
No, they just have to be public about it, yeah. You have to, if you're an insider, a management or a board member, and you're selling or buying shares of stock, that has to become public information. It can't be withheld from other shareholders.
So I'm sorry, I still don't understand about shares. So let's say we're in this situation and that maybe there were 100 shares and that we all own them.
There were 100,000 shares, yeah.
Okay, and so we can just, as a board, we can say, we're going to double that?
Oh, so when a company is created, as part of its incorporation, it declares a number of authorized shares. And it can be any number they want to be authorized shares, okay? And then the company periodically can sell some of those authorized shares. Those become outstanding shares. Outstanding in the sense that they're owned by people outside the business, okay? So they're authorized shares, which is in your articles of incorporation, okay? And you can sell as many of those shares up to the authorized amount. The number you sell is called the outstanding shares. Right? And when you look at the reports on share price and everything, it's always not per authorized share, but per outstanding share.
So what would happen in this situation if all the authorized shares had been sold?
Right. So then in which case you go back to the shareholders, not to the board. The board can decide, hey, if there's some more authorized shares but not issued, the board on its own can decide that we're going to sell some more of the authorized but not issued shares. The board can decide to sell more of those authorized shares. If you're bumping up against authorized share limit, then you have to go back to the shareholders. And the shareholders would have to agree to authorize a bigger number. Only the shareholders could do that. In this case, we still got some shares we could sell. There's more authorized but not issued shares.
So if the board were to authorize more shares...
No, the board can't authorize more shares.
I'm sorry, I apologize. If the shareholders were to
Right.
authorize more shares, wouldn't that reduce their share value because they're diluting the number of...
Well, every time you sell another share, you're diluting the current ownership. The question is, with the money that you got by diluting the ownership, did that more than proportionately increase the profitability of the company? In other words, if I can dilute by 10%, but I can improve profitability by 20%, the shareholders are ahead, right? If I dilute by 10% and only improve profits 5%, the shareholders are worse off. Right? So the question, what kind of return are you going to get on that money that you raise by diluting ownership? If you can get a more than proportional return, then I can argue to the shareholders, it's good for you. True, your ownership is diluted, but your profits per share will go up. That makes sense? Does that answer your question? Thomas, you're just thinking? Okay.
So do the shareholders have a say in whether the stocks get diluted or not? I'm guessing they should, right?
No, the shareholders get, if it comes to it, to decide on the number of authorized shares. Right? That has to be done by the shareholders, okay? The board gets to decide whether to sell additional shares from among those that are authorized but not yet sold. The board does that on behalf of the shareholders. Remember, they're acting as the agent of all of the shareholders. So they can say, let's dilute the ownership. Right? But if you're not talking about how broadly can ownership be shared, number of authorized shares, then the shareholders have to decide that.
So if the board had a majority share, then they could make both decisions because we would be acting as the shareholders.
Yep. So I talked about our chairman and wanting to pay dividends in a year in which we lost money. And I would be stupid enough to raise questions about this and ask whether it was wise or not. Ultimately, it came down to pretty simple. He owned the majority of shares in the company, right? So anything he wanted to do didn't matter what the board wanted, right? The board was, to a certain extent, window dressing, but also helped him think through decisions and do other things. But when push came to shove, he just pulled out his ownership position and sort of said, great discussion, here's what we're going to do. Right? And he was very, very careful not ever to lose majority position, that by himself, right, he could do it. Same thing is happening with a lot of startup companies. They're issuing different categories of stock, and so they don't necessarily, different stock has different voting right? So the people who formed the company, their shares count for 20, right? And the new people count for 1. So they maintain voting control of the company, even though they don't own the majority of shares, because there are different classes of voting stock. Right? That may be in more detail than you want to know. But this is why it becomes important for people to control the company, right? And so if you got a board, 2 or 3 people collectively together own the majority of shares, the company's going to do what they want to do. Right? In our case, it's pretty simple. The chairman was going to do what he wanted to do. We had a chance to influence that, and we did do our best to help him come up with a good plan of action. But when push came to shove, he said, thank you very much. Here's what I'm going to do. Here's what we're going to do. Here's a big user of we. We usually meant me. Great guy. We're still great friends. Okay, you with me so far here? You getting a sense of, this is really what financial statements in business is about, okay? These financial statements simply give you some insight, potential insight into what's happening. And so after a while you learn how do you calculate this stuff, but then the more important thing is, what does it mean, right? Where are the issues? Where are the opportunities, right? That's what you need to get good at. And in your own private investments, you need to get good at that. To say, hey, in this company, here's where I think the issue is. Now I want to understand this, so I'm going to do some work to understand this before I put my money into this. Or before I sign on with this company and become an employee, here's the things that I would want to understand better. if someday you serve on a board, right? So you get these financial statements. You know you're only going to have a limited period of time to have this discussion. So if I only get one question, what's my one question? If I get two questions, what's my two questions? On the board will be some people who haven't got a clue about financial statements. They're there because they know stuff about marketing, or they may represent some other interest, right? You have to have a balanced board so various perspectives get into the conversation. Should we go into this marketplace? Accountant's not going to tell you anything about that, right? You hope you would have on your board somebody who understood that marketplace as you think about strategic plans, right? So usually a board gets down to, you hope you've got at least a couple of board members who are interested enough to really dig into this financial information and ask good questions, right? So this gets into the question of how do you put together a good board, right, that is helpful. And one of the helpful skills would be somebody who can quickly look at financial information and draw out the key questions from those financial statements and engage in a conversation about that. Okay. Balance sheet, asset, cash. AR stands for what? Accounts receivable. This is what? Money that customers owe us, right? So it grew. We'd want to look at a question of, did it grow faster than sales? Right? If it grew faster than sales, we might be having a problem in what? Collecting from our customers. Right? So we'd want to, and we'll do some percentage stuff a little bit later on here. Inventories. 750, 1,287,000. We've got over an additional $500,000 of cash tied up in inventory. Suppose we only had $400,000 less of inventory, $400,000 more inventory, and we had an extra $1,000 in cash, because it cost us cash to build that inventory. Right? We paid for our suppliers for the net product. We paid our employees. Right? We did all of that stuff to produce inventory. So do we have a lot of money tied up in inventory? Yeah, I would say that $1.3 million in inventory is a big number. Suppose there had been a way to not grow our inventory at all, but still expand. Thereby saving us, what, $500,000. There's a whole school of thought called lean manufacturing that's precisely about that kind of question. How could we do this? Well, suppose we were able to do stuff just in time. Suppose we didn't buy our net products, and suppose we didn't package them, and suppose we didn't put them on the shelf, okay, and we could collapse the time it took to do that. Right? Suppose that every time one of our retailers said, we just sold 1,000 packages of this nut product, we could give them a new 1,000 packages within a day. Right? That we were much more agile in building inventory and in replacing inventory. Right? In my manufacturing companies, our major customers sort of said, twice a day we're going to tell you how much of this we want. We had 1,000 part numbers. Right? In the morning, thing would come and say, we want, of those 1,000 part numbers, we want this, this, and this, and we want 5, 3, 7, 10. And you had 2 hours to deliver it to them. Right? And then in the afternoon, same thing. Right? So, and you never knew in the morning or the afternoon how much they were going to order and which things they were going to order. Right? So they would order it, right? And as soon as they ordered, that laid out our production schedule for the next day. We have to produce these quantities. Now, if it took us, let's say 30 days, because it was a complicated product and you needed to get you need to get material and their outside suppliers. If it took us 30 days to replace that, then we needed to have a pretty big inventory, because while we could begin making to replacement, in the interim, we had to depend upon in stock to fulfill anything that they requested. So we always went to work to replace that, but if it took us 30 days, we needed to have 30 days of potential supply to be able to handle their daily demands. But now suppose that it didn't take us 30 days, it took us 2 weeks. We could shrink our inventory, right? Because it only had to last us for 2 weeks, right? Well, suppose we could do it in a week, right? Well, suppose we could do this. We wouldn't need any inventory, right? So are there ways that a company could in fact grow and not expand its inventory? Absolutely. It's called agile or just-in-time manufacturing. Right? If this company were able to do that, it could save $500,000. Wouldn't have to borrow that much money, wouldn't have to sell that much equity, right? But this company takes the easy way out. It sort of presumes if it's going to expand, it has to blow everything up. Right? I'll give you another example. They've doubled their manufacturing capacity. We bumped into this problem all the time. Well, could it be that somebody else could actually prepare these nuts, that in fact the raw material could go into them, they could roast it, they could package it, and they could give it to you to put in your inventory? Are there people who could supplement your manufacturing? Absolutely. Then we don't have to put our hundreds of thousands of dollars into equipment. There are already people who have put the $100,000 into their equipment, and they would love the opportunity to make this product for you. So doubling your capability does not necessarily mean the same thing as doubling your manufacturing capability. Okay, well, we're running out of time. So I've got you started. We're just starting the journey. Right, we'll be on it for at least another 2 weeks, because I view this as the core of the course. This is getting you as close as I can create it. Okay, what life is really like. Right? All right, so look at the data maybe more carefully. I think you will see some projections for next year. So you're going to have to say, am I prepared to go along with what I'm proposing for next year? What would your plan look like for next year? Because you have to prove a budget. The great question of Thomas, like, how did we do this year? Well, in order to answer that, one of the pieces of information I need is what was our budget? Right? So we're going to have to put a budget out for next year. So that's one of the things you're going to have to decide on as we go ahead. So takeaways. Jesse.
Biggest takeaway would be that even after only a couple weeks of knowing what financial statements there are, I'm already seeing a bunch of things I recognize that I just didn't know about in the past.
Yeah.
And it's not as complicated as I would have thought it would be.
Good.
There's only so many places the money can go and be taken out of.
Right.
And ideally, you can track it down pretty quickly.
Gabe?
I think just as we kind of get into all these statements and reinforcing all the names for all the different parts of the statement, that's kind of the things I'm starting to take away, is hearing, I think like net income, profit loss, earnings, income, that all kind of is the same thing. And that's kind of becoming more familiar to me.
Yeah, let me sort of say, I think I've mentioned this before. This is a subject area where repeated exposure, repeat it, and eventually it starts to sink in, because there's so many ambiguities about all these terms that refer to the same thing. Okay, but if you keep working at it, it'll get clearer and clearer and clearer. Okay, you won't get sidetracked about, I never heard that before. And they say, well, that's the same as this. Well, then now I understand. Dan?
Similar, getting more familiar with the terms is really helpful week after week. And then also learning today a little bit more about how big decisions are made in the board of directors and stuff like that. I'm
trying to give you at least a little sense of that. Yep, Thomas?
What stood out to me was not so much as like recognizing what things are, because when we throw them up on the slides, I'm like, oh, I understand what a balance sheet is, but getting better, what we're going through today, of looking at it and using that information to find the right questions to ask.
Good.
Extracting the information rather than just knowing what it is.
Coulter, your takeaway.
Cash is king, obviously, and this company is in a whole world of hurt unless they figure out something to do pronto.
Okay, great. We all agree with that one, yep. Carla.
So my takeaway is that I've been a business of one for a number of decades without this information, and it's worked out okay. But I'm really appreciating the information and the opportunity to learn about managing finances on a much larger scale. Sometimes this actually feels kind of fun.
Well, this is what I find fascinating about it. I mean, just there's a story, and you need to understand the story, and you need to be able to find out the central themes of that story and what's the most important thing going on here. So when you get to that, where you're comfortable enough with the terms and when you're comfortable enough with the calculations, then finding out the story, what's going on here, and what should we do, then it grabs you. Then it really becomes interesting. Nathan?
So it's kind of obvious, like, when you showed the first statement saying, like, oh, where's the problem? Like, oh, I see it right there. That's the one that makes the most sense. But then it's like, well, why is it the problem? Like, what makes it that? And then going, more in depth, it's like, well, that's still a problem, but then you could take this factor out and this factor out. So the more you go along and figuring out, you might see it initially, like, here's your problem, but it takes a lot more research and looking at all the other different statements to figure out what to actually change and that sort of thing.
Yeah, there's a bit of detective work to be done, no question about it.
I kind of follow up on that one, that you need some supplement data with the balance sheets to make your decisions. There's always other things you need to know as well.
Shannon?
Yeah, just getting a better understanding versus just reviewing how it all starts to interact.
Mm-hmm.
Mine was actually the inventory part. I did my undergrad in mechanical engineering. We actually learned just in time as part of the course. Yeah. And the thing is, back then, I don't know if I zoned out in class or something, but to me it was just about trying to have like a lean inventory. I didn't realize that it would actually affect the balance sheet and stuff like that. So it was really cool. Like, after 3 years, I finally understood what it's for.
Yeah, and that inventory really numbers the investment of a heck of a lot of cash, right? And why do I need to invest that much? And are there ways where I could invest less in that? Or here's all this equipment that takes a lot of cash. Are there alternatives to my having the equipment? Could I perhaps find another way to get this made without my having to buy and use the equipment? Noah?
I'm like a lot of people are saying, I think the sleuthing work is really interesting. It's also, I'm enjoying learning that there are sort of secondary and tertiary tools, just ways of analyzing the information. I wouldn't have thought of that, so I'm from the outside. So it's great. It's opening new horizons.
Good. See you next week.